Hey everyone, welcome to another episode. I'm Dave Hathaway. I have an awesome guest, Shaun Magner with Monument City Capital, a hard money lender. We're going to discuss hard money lending, but in specific, we're going to go into an example of how a successful investor used hard money lending on a property, all the specifics of that property, and how you can use it to scale your rental portfolio. So at the end of the video, you're going to know what hard money lending is. You're going to know how you can use it to scale your rental portfolio, and you're going to get to see that real life example. So let me introduce Shaun Magner. Hey, Shaun, thanks for hopping on the interview. How are you?
Good, buddy. How are you?
Good.
Thanks
You're
for
the
having me.
expert of hard money lending. So if you don't mind just sharing what is hard money lending, just in a brief, short, and kind of the benefits of it.
Sure. So I always explain hard money as this. We are somewhere at a crossroads between private money and a bank. So private money being friends and family money, a bank being obviously highly institutionalized debt. We are basically, hard money can best be described in my own definition as private lending for the acquisition and or renovation of investment real estate, specifically for real estate investors. So it's just niche private lending. And when I say crossroads of a bank and private money, we have the speed and ease benefits of both. So the speed, I'll give you an example. In 2024, I funded 4 different loans within 24 hours of them first being presented to me, meaning I moved money out of our account within 24 hours of those loans first being presented to me. No bank in town is going to pull that off. We're also a moderately low doc type of an underwriting, right? We're not going to require personal financial statements like a bank will. We don't require tax returns like a bank will. So that's where we're kind of right in the middle road. So the speed and ease, and then the third piece is willingness, meaning if you walk into a bank and you've got a house that's got a tree growing through the roof, that bank may say no, and we might say yes.
Yeah, I love that. A lot of regular institutions don't lend on properties that don't have certain criteria, i.e. kitchen, i.e. flooring, i.e. even if it's a great house and doesn't have carpet, some banks won't loan on it.
Right. They consider that habitable or not. And if it's not considered to be habitable, they'll just say no. Whereas most of what we do is lend on houses that are not habitable.
Yeah, and these are value add properties where you're doing a heavy rehab normally, correct?
That's right. Yep.
And for people that might be scared of hard money lending or don't understand what it is still, do you need money to qualify for hard money lending? Do you need credit? Are those two things that investors need?
You do. They do. They need both. We typically, based on our average loan size and our historical numbers, we like to see that our borrowers have a liquidity position of around $40,000. That's cash to close and enough money to get the construction started. So $40,000 or so is about average in our loan portfolio. $1 million loan, that's not going to be enough. $100,000 loan, that might be too much. And as far as credit goes, absolutely. Now, you might have an 800 credit score, but you might also have a history of not paying your lenders, and I need to see that, especially if my getting paid back is dependent on my borrower qualifying for a refinance loan. I absolutely need to see their credit. If they're doing a BRRRR, buy, renovate, rent, refinance. If they're buying a fix and flip, the credit is still important, but it's not as important, right? Meaning it doesn't take any sort of financial credentials to list a property for sale.
Yeah, that makes a lot of sense. And how are investors normally using these? Is it straight just value add properties and using them for flips? Are they using them for rentals? Are you seeing the successful investors that you work with do kind of a split between those two?
It's all of the above. So I'll say maybe about 2 years ago or so, I was about 3/4 of the portfolio of my loan portfolio were for rental properties. About a quarter was fix and flip. Now it's about 50-50. I have a feeling that interest rates have something to do with that. But so BRRRR, people buying, renovating, and renting, refinancing properties, and those that are flipping houses for sure. But then there's also the folks that need some gap funding, some bridge funding, some temporary debt that they might have a really good turnkey opportunity. But if they were to buy that in a DSCR loan, that lender is going to require a sizable down payment based on the purchase price. That they might benefit from if they buy it well enough and they get it under contract for a really good price, they might benefit from buying it with a hard money loan and then immediately starting the refinance, because on a refinance of a debt service coverage ratio loan, the loan amount is now based on the appraised value, not the acquisition price. So there's a benefit there too. So most of what we do is fix and flip or fix to rent, but we do some kind of bridge type loans as well. And we've also done some transaction loans. And a transaction loan might be something where a 24-hour type of a loan where a buyer is doing a double close. I'll let you elaborate on what that is if you'd like. But instead of assigning the contract, they do a double close, and somebody has to fund that first settlement. Even if the second close is an hour later, there has to be some money in place to acquire that. So we've done some of that as well. But the lion's share of what we do is fix and flip or fix to rent.
Yeah, that makes a lot of sense for successful investors doing that. I also, from my own experience using hard money lending, which we haven't really touched on, but I think is super important for newer investors, most people don't have an infinite amount of cash. And so where hard money comes into play is maybe you're purchasing one property a year. And maybe that's sustainable if you have a W-2 job or you're getting into real estate. But if you want to scale that rental portfolio, if you want to purchase 2, 3, 5, 20 properties, eventually you're just going to run out of cash.
Right.
Whether you're the most successful investor ever or you're just starting out, you're going to run out of cash on that second, that third, that fourth property. And so this is where this instrument really helps out, is it bridges the gap and it allows you to purchase properties, fix them up, and then refinance out of them into long-term debt. And as long as you're purchasing right, you can continue this process over and over again and kind of recycle your money when you hear recycling your money. And we're going to hit this specific property example that Shaun has graciously shared that one of his successful investors have done, because I think it gives us the visual of how it works from start to finish. So you can start visualizing, that's how I use hard money. That's, even though it costs more than regular money, this is why it helps people scale their portfolio and be successful. So we're going to discuss the property address 5720 Cynthia Terrace, Baltimore, Maryland, 21206. And I'm queuing the address up for you. We'll probably have a listing picture up there for you guys to look at. But if you could just start us out with, Shaun, so you had an investor that came to you and just walk me through the initial process. He was looking to purchase this property at foreclosure. Is that right?
That's right. Yeah. This borrower, his name is Leo, and Leo is a contractor. He'd been doing a lot of residential remodeling for others and wanted to get into the investment business himself. And so he found a property by way of an agent that he knows, a real estate agent that he works with. And it was an REO, so a bank-owned property. So at some point, the bank took ownership of this asset from somebody else. So he approached me and we had a nice conversation. He laid out all the numbers. I can explain exactly the process from start to finish, but we had an initial phone call, and then he went to my website to fill out our application. And what the application is a simple Google form that collects both borrower information as well as deal information so that I can underwrite both. And what I underwrote it, I came up with a deal calculator and I shared it back with him. And my deal calculator basically lays out his expected cash to close, so his skin in the game, if you will, how much money he was going to need to bring to the table, my loan amount based on my underwriting, and it just kind of laid out his expected profit as well. So I shared that with him. He liked the numbers. I liked the deal. We now signed a term sheet and sent it off to the title company to get us to the settlement.
Yeah, let's dig into those numbers a little bit. So he wanted to purchase the property for how much? Did he
I'm going to be looking over here for a minute because I've got it queued up on the screen here. But his acquisition price was $195,000. $195 was his purchase price.
Gotcha. And then you were funding that acquisition fee. Were you also funding the rehab for him? I'm assuming this was going to be a flip, was his initial intention going in.
That's right. He was planning to flip this thing. And being that he's a contractor, he obviously had an edge on a normal investor that has to hire a contractor. But there was a $60,000 rehab component to this that I also funded. Yes.
Okay. And then how much did he use for like a down payment? How much did he need for, you mentioned that number, which I really like, cash to close. How much did he need to bring to the table outside of your loan to help him close on the property?
You got it. So the best way to explain that would be, well, I was going to jump ahead to ARV, but let's just talk about your question specifically. He had to put a $19,000 deposit down. So he had EMD $19,000, which is a pretty high deposit. Being that it was bank owned, they might have required this bigger deposit for that reason, but he had to put $19,000 down. And then he had to bring another $27,700 to settlement. So for a total of around 46 and some change, just under $47,000 all in cash to close.
Okay. And then you underwrote the property as a hard money lender. How much did you underwrite the property, if you want to discuss ARV and loan to value real quick so people can understand both of those numbers and breakdown of the property?
Sure. So ARV, after repair value, what the asset will be worth when it's done, what will appraise for if it's a rental or sell for as it's a flip. In this case, his ARV was $350,000, and our loan to value, LTV, that's loan to value, and the value being the ARV, is 65%. So we did a $227,500 loan. Again, 65% of $350 is $227,500. I held back $60,000 in rehab escrow for his renovations, which meant that I could fund $167,500 of his $195,000 purchase.
Gotcha. And then let's talk about rehab and draw. So he's
Sure.
gotten to close at this point. He has a $60,000, is that right? $60,000 for the rehab set aside. And how is
Yep.
he drawing that money down when he's doing the work?
So we agreed to 3 draws, and a draw is simply when a renovation or an investor reaches a certain milestone or progress milestone in the construction phase, he'll call us up and we'll go out, do a draw inspection, and release some of the rehab escrow. The lender's always going to be, should always be, behind the construction, so our money's not out in front of the construction, thus keeping the capital safe. And so in our case, he had a $60,000 rehab budget, and we did 3 draws. So he basically needed to get to $20,000 or a third of the way through the project and then call us up and ask for us to release a draw. So to speak to that, we mentioned already he had to bring about 47,000 cash to close. Since he also had this rehab component, he needed to show another $20,000 in reserves to show that he had the money to get the construction to the first draw, right? And so he did some of the work himself and then called me up. I think he called 3 weeks or so after the settlement for his first draw.
Yeah, I think that's thank you for noting that. It's super important to understand draws for the rehab as an investor, and also understand that you might not be able to work with every single contractor out there. Either you have the money up front to get through that first third of the rehab, which is $20,000. Maybe you have that in your bank account. That's great. Or you have to work with a contractor and say, hey, we got to get to a certain point for me to get the draw. Not all contractors, and it's not good contractors, bad contractors. Not all contractors are willing to deal with that, because that adds a level of risk for that contractor of like, hey man, if you don't have it and you're maybe lying to me about that lender. And so this is just another part of hard money lending you have to kind of understand and you need to plan for.
I agree with you. And while we're on the topic of draws, I think it's also important to add that when a borrower calls me and they're ready for a draw, that takes the precedence. That takes the primary seat on my calendar. I move things around to get out there to do draw inspections if need be. And the reason for it is I have the mindset, and I hope that other lenders do as well, that if I don't fund your draw soon enough, you're not going to be able to pay your contractor, and that's going to cause him to possibly walk off your job or at least stop working. And I don't ever want to be the reason that a project is stalled. So we jump on those. We will be out there within 24 hours. 24 to 48 hours, of course, and then I'll release the money the same day. And that's just an important point to make, that draws, I drop everything for those.
No, I love that. And I love that you shared that. It's important. And then as far as, so we're getting through the rehab at this point, how much is this investor paying in? Is it interest only payments? Is he paying down like a normal loan where you have a principal pay down? Talk to me about that. And when are the payments due 1 month after he closes on the property, or they do at the very end of the loan? Talk me through that.
Good question. So we do not defer our interest payments to the end. We do require monthly payments along the way. It is an interest-only loan. There is no amortization. There's no principal pay down. This is an interest-only short-term fix and flip, fix-to-rent type of a loan. Most hard money lenders are that way. His mortgage payment, we charge 12% interest in our business. And here in the Mid-Atlantic, it's somewhere between 10 and 14% interest is pretty common. We charge 12 right down the middle. And I do that honestly for this reason. It's simple math. If it was 13 or 11, I'd have to break out a calculator. Since it's 12% and there's 12 months in a year, I know on a $227,500 loan, to your question, his payment monthly was $2,275. And to your other, you also mentioned or asked about when his first mortgage payment is due. And it is just like a normal mortgage in that this hard money payments, like a standard mortgage, are paid in arrears. So he settled on this thing, I think it was early in June of last year, and his first payment was then not due until August 1st.
Yeah. Usually there's a lapse if you don't close on like the 30th. You kind of get a 2-month or a 60-day lapse.
Yeah. So it's always ideal for the borrower if they can close early in the month, the better, because if they can close on the 2nd of the month, I'm going to collect odd days interest for that month at settlement. They're not going to make a payment the following month, and then the next full month they do. So they usually get about a 2-month window. I actually had a borrower last year, a little side story. I released his final draw. His house was listed before his first payment was due.
Yeah, that's great.
Yeah, that's moving. That's efficiency.
I mean, and with hard money lending, so this property or any property for that matter, this is an instrument or a tool that you want to get your project done fast. This isn't an instrument that, and you can correct me if I'm wrong, that you're trying to do a 12-month renovation. You're trying to get in and out and on to the next project. And so you can start to recycle that money. Is that right?
Yes, that is right. I'll also say though, some our loans are 6-month loans with extensions available. Historically, most of our borrowers pay off in around 160 days, so they don't. Not most of our borrowers don't need extensions. But if you're doing a $200,000 historic farmhouse remodel, yeah, you're probably going to hold on to that thing for a while. That loan's gonna that renovation's going to take some time. Our average rehab is about $60,000, and so for somebody to go from settlement to settlement, acquisition, then they renovate it, and the resale settlement or the refinance settlement. In our case, it's usually less than 6 months. So I want to also speak to that. People hear hard money and they think it's expensive, and it's higher interest rate than a bank loan. Yes. However, most of our borrowers are paying off, like I said, in 5 or 6 months. Since it's an annualized loan, that 12% is per annum. So you're paying 1 point per month, 12% interest per month. If you pay the loan off in 6 months, you're paying 6% interest on the money, not 12.
Yeah. No, I love that. Thank you for sharing that. All right, let's move on to, we've finished the rehab, and then how much was that investor's entire rehab? Do you know how much he spent on the entire rehab?
I don't know that he went over. I don't even know if he spent the full 60. Again, he had an edge because he is a contractor, right? And so he had his own guys working on his project. And so Leo, again, is his name. Last I knew that he stayed on budget. He might have gone over, but if he did go over, it came out of his pocket and I wasn't made aware.
Gotcha. And so so we'll just say the rehab was 60,000 and he's stuck in that budget. Yep. Obviously, if you're a contractor, you're doing the work, you're going to have the edge. And then his cash to close again was 47, right around 47,000. And that's how much he needed to get to the table, to close the loan, to start getting then to the rehab, to get the rehab payments. And then how much and you mentioned his, and you just correct me if I'm wrong. I'm just spitting back information that you're giving me. The monthly interest payments that he was making were $2275. Okay. Yep. And how long did it take for him to pay off this? Was it 5 months?
It was 132 days. I have his payoff statement in front of me. That's why I'm not.
I love it.
Yeah, I'm not Rain Man. I don't pull those numbers out, but I'm looking at the payoff statement in front of me. And 132 days. He 6/21 to 10/31. This is of 2024. So all in, his total interest was $10,010.
Nice. And then on the side, we're going to have some walkthrough. Shaun's providing some nice walkthrough videos of when you do the draw. You normally walk through the entire property to obviously make sure whatever was said is done. And so you can kind of see going through the property that there's a project going on. And so his total Leo's total all-in cost, how much was that for like cash to close, his interest payment, everything bundled together that came out of his pocket?
Just under 57K, about 56.9.
And then he ended up selling this property. For how much did he sell the property for?
339.9. We underwrote it to 350. It actually ended up closing for 340.
And then his total profit, did he end up executing on his plan? What was his total profit on that?
He had a total net profit. No, I shouldn't say net, a gross profit. This is before taxes, of course, but 36.3. So a little over $36,000 he made. And so what's 132 days? Is that 5 months or so? What's 132 days?
That is a little over 4 months.
All right. So in
4 months.
So let's say in 4 months, he made $36,000 in 4 months.
Okay. That number is relative to how much he put into the property because it's basically like a return. And so he put in $57,000, right? Roughly. And he made $36,000 roughly. And you're looking at, does that include the fees on the back end for his sale for the $36,000? Does that include like the agent fee of him selling? Normally, how successful investors work is they're going to stage the property, which I believe he did. If you see the pictures, he very nicely staged the property. He very nicely, so I'll give him a huge kudos, nicely renovated the property. It wasn't sloppily done. Super important that you do quality work or else you're not going to reach your numbers at all. But you're including and where I was going with that is that successful investors normally list with agents because you're going to get a bigger pool of buyers when you do that. So they're normally listing on MLS. Is that correct?
That's right.
And so after all of that, you're saying he got a $36,000 profit, gross profit, but that includes his agent fees and all the fees that go to closing the property.
That's right. And that's right. I provided him, as I mentioned earlier, I provided him with our calculator. We call it a gross profit estimator. And there is a column that we account for both purchase costs on the front side and sales costs on the back side. The sales costs include commissions to realtors, local and state transfer tax, recordation taxes, his carrying costs, meaning his interest payments, staging, utilities, things that some investors tend to overlook. So we want to make sure we include all that. And so, yeah, it does include his commissions to his agent on the backside.
Nice. And I pulled up a calculator while you're talking to do some math. So I didn't sound like an idiot, but 36,000 divided by 57,000. So 36,000, gross profit. 57,000 was how much that he put into the deal. It's a 63% return. And so if he was
cash
to
on
do
cash
this,
return.
yeah, cash on cash return. So if he were to do this multiple times, you can see that it's a 63% return is really good. So he sold this one off. If he were to turn this into a rental, he'd probably move the DSCR route and get a 30-year fixed DSCR loan. If you don't know what that is, I'll throw up a video over here so you can learn a little bit more about DSCR loans if you're going to do a buy and hold. But if you're doing a flip, you're flipping it, you're selling it, and then you're going to recycle that and then put that money in another property, purchase another flip, do it over and over again. Did we miss any details there that you feel like are super important?
No. As I'm looking through my notes here, as I prepped for the call, no, I don't. We've hit all the important numbers, all the important points. He did a successful deal. This is a good deal. There are a number of things that could have happened along the way to make this an unsuccessful deal, right? But that they didn't. And I only mention that because not every deal that you do is going to be a home run. I would say this is a home run, a double or a triple for sure. He did a good deal here. And a lot of our borrowers, I also want to mention this, a lot of our borrowers target a 10% gross profit ROI, meaning of the sale price, they hope to pocket about 10% of the ARV. So if this thing sold for $350, he was hoping to make $35,000. It sold for $340 and he made $36,000. So he did a good job. This is a sweet deal, but it certainly, they don't all go this way. And it's unrealistic to think that every deal you do is going to be a winner, just for what that's worth.
And we're looking also, just so you know, we're looking at this at a super high level. So even though we're just talking numbers, I'm sure it didn't feel like this to him during the renovation. Sometimes there's permitting stuff and other things that come up as an investor. You kind of learn and adapt. That's why it's always good to have a mentor or talk to, a meetup group where you can say, hey, I'm going through this issue. How have you guys done it? So when Shaun's saying that this was smooth sailing, it was smooth sailing for the numbers and it was very successful. Right. He did a successful deal. It doesn't mean that everything was perfect, at least if we were in his shoes. So we don't want to totally sugarcoat it where it's like, hey, everything went perfect.
Yeah.
Only Leo can probably attest to that. But he did do a successful deal.
You're right, man.
Yeah, I want to be real. I want to be transparent, so people aren't going to go, "Hey, man, you guys said that this is how it's going to work, and it didn't work like that."
That's kind of,
and they tore me apart.
That's why I mentioned that they're not all home runs. If Leo was on this call, he would be saying, yeah, your spreadsheet looks great, Shaun, but let me tell you about the gray hairs I got because of that project. That's you're right.
I love that. If investors are looking they want to do this exact same thing, how do they reach out to you? If they're interested in hard money lending, how do they reach out to you, Monument City Capital? Can you go ahead and give yourself a plug? Where can they reach out to you?
Sure. As you well know, I'm pretty active on all the socials. I'm a 41-year-old man, so I'm Instagram and Facebook primarily, but we're on LinkedIn, TikTok, and YouTube as well. But monumentcitycapital.com is the website. Shaun at monumentcitygroup.com is my email. I'm sure David will share that as well. The best way to reach me is either find me on socials or reach out to me via email, or just go to our website and drop your information there and I'll give you a holler.
Yeah. Thank you so much for sharing your experience, sharing your time. If you guys have any questions at all, you guys are like, hey, I didn't understand what you're talking about in that deal, or I missed this number, or what do you have any questions at all for me, for Shaun, put them down in the comments. We'll reach back out to you. We'll answer your questions. We want it to be crystal clear how hard money works, how you can make it work for you and scale your portfolio. So with that, we'll see you guys in another video.